Not all whole life insurance is created equally. Now, I've done videos talking about the best way to design policies, and we've gone through that in great detail on this channel. But one of the things that I think is overlooked greatly by most people is what are the elements inside of a policy that you need to consider to figure out, is it right for you? Is this where you want to put your money? Now, this doesn't really matter if it's a big four company, if it's another company. Obviously, there's all sorts of different companies out there. At the end of the day, if you're working with a participating mutually held life insurance company, you're going to be in good shape. But even if you're working in that framework, there are different things you need to consider to figure out, is it the right plan for you? I'm going to be covering those things in this video. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video, because I'm launching videos like this every single day. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. For this video, we're going to be talking about the different things to contemplate or consider when you're thinking about buying a whole life insurance policy. I got them on my board behind me, written out a little bit, but I want to go through them in detailed fashion, one by one. So, as you can see here, the first thing is dividend rates. I'm not going to spend a lot of time on this. This is a very obvious one. This is kind of the one that people pay the most attention to, but honestly, it's probably the one that means the least out of the entire spectrum of things. There are companies out there that have a 6% dividend rate, and there are companies that have dividend rates in the low to mid fours. Which one is better? It doesn't matter. The dividend rate is only impactful, from the illustration perspective, and even then, it's not even really that relevant because the dividend rate that we see is just a gross rate, right? Like, it's not a net rate, because you see the dividend rate and then they have to take out all the cost of insurance and the charges and the fees and the operations costs of running a business. Then whatever's left is going to be a net rate that gets passed along to the policyholders. And so if we have a 6% dividend rate, doesn't mean you're going to get 6% on your money. That's the gross rate. You got to factor in the net rate. Now, so when we look at that, what is the actual return inside of a policy? At the end of the day, all of these companies, I don't care if you're talking about your big four, like your Mass Mutuals and your Guardians and your New York Lifes and Northwestern Mutuals and those companies, or you're talking about the smaller companies that are still really good players in the space, companies like One America and Lafayette. Those companies are really good as well, and there's other companies as well. So I'm just not going to name all of them off. When it comes down to it, if you look at these companies, they all have general funds. When you understand the flow of money inside of a life insurance contract, you're putting money into a premium. That premium deposit is going into the general fund of the life insurance company, and that life insurance company is going to manage that money, right? It goes into their portfolio, and you're going to get a dividend based on a return of premium inside of the performance and the profitability of the company, right? Of the mutual company. When you look at that, all of these companies operate under the same regulations. Now, there may be little differences, but for the most part, they're all doing the same things with their general fund. So it doesn't matter if you're talking a big company or a small company. For the most part, they're doing the same things. So now it comes into the case of like the dividend rate, what is the gross versus the net dividend? That could be debatable. That's really hard to figure out sometimes. At the end of the day, what really matters is not what is the dividend rate and how is that going to function, because that's going to have the least amount to do with your profitability in the policy, right? What's going to have to do with your profitability and leverage of that policy is you and how you use it. And so therefore, rather than focusing on the dividend rate, what we should be focusing on is how is this policy going to perform based on our behavior with it, and what things do I have to consider to figure that out. And so the first thing that we have to consider is the loan rate. Now, a lot of companies will have higher dividend rates, and they'll also have higher loan rates that go along with it. Some companies may have lower dividend rates, but they have lower loan rates. And so if you plan on leveraging your policy for loans, for real estate or for business or for anything else, the loan rate can actually have a bigger impact on the policy growth long term than the dividend rate. And that's a really important thing to understand. So there's a lot of these companies that come into this and they go, okay, I want to do this policy with this specific base to paid up additions blend, and like I want to maximize it for all these different things for cash value. This is where the 90-10 policy kind of comes into consideration. A lot of people think that that's the best way to do it. Sometimes it is, a lot of times it's not, right? And I've done a video on this recently talking about that. But what I will say in this instance is the important thing to think about is not just what's the dividend and what's the blend of the policy, but if you plan to use the policy a certain way, what's that loan rate? Now, you have to look at what is the current loan rate, how do they factor their loan rate, how do they create their loan rate, what are the variables that impact the loan rate. Like for instance, some loan rates are able to jump really fast. All loan rates have a cap of 8% on a whole life policy, which is fantastic, but some loan rates are able to jump faster than others. The current loan rate for new business with a company isn't necessarily the loan rate for old business. There are certain barriers and protections for current policyholders to keep the loan rates from jumping up too soon. For instance, I was just having a conversation with a client and they were like, Chris, if I were to utilize, let's say I wanted to buy a $250,000 real estate investment property, I could go out and I could get a loan from a bank, or I could get a loan, or I could use a policy loan and just fund it all myself. What am I gonna do? Should I just use the policy loan for a down payment, or should I use it for the whole thing? Well, a year ago, that would have been a different answer. Now we have to look at the loan rate. And in this instance, we were able to look at a loan rate with one of the companies we work with, and the loan rate was still under 5% because his policy was older, it was mature, and you could look at that and it was what it was. Under 5% for a rental property. If you were to go get a rental property loan rate for a second mortgage or an investment loan, you're looking at 7% right now with a bank. And so not only are you able to get cheaper money now inside of a life insurance policy, whereas a year ago, the bank was going to be cheaper than the whole life policy loan every single time. So these are variables that are going to change circumstantially and environmentally, and they're going to change over time. So you just need to understand the different moving parts. Whereas a year ago, my answer would have been different than it is today. You have to understand that the loan rate is a big factor here, and that knowing how to pick the company that has the best loan rate can make the difference of literally tens, if not hundreds of thousands of dollars of your policy over, the 30 to 40 years that you're going to be leveraging it out. That's a really important thing to understand. So the next thing that I would consider is the paid up additions load fees. Now, when we talk about designing, and this is actually number 2 on my list, I just jumped ahead and I'm bouncing around here. But when we look at the paid up addition load fees, a lot of people are doing policies with companies like Guardian and MassMutual. Once again, I don't have a problem with those companies, but their load fees for their paid up additions are expensive. I know in some instances, Guardian, for instance, has paid up addition load fees of 7 and 11%. Depending on the policy that you go with. And most of the policies that are being sold are actually being sold with the 11% paid up additions load fee. So that means if you do a 90% paid up additions, like a 1090 policy, that means out of if you did $100,000 premium and $90,000 is going in there, you're gonna have $9,100 basically as a load, or $9,900 as a load fee for that paid up additions. That's expensive. That is detrimental to you accomplishing your goals, whereas other companies have very minimal load fees that are literally less than half of what we're talking about for Guardian. And so when we look at that, those are all contemplations when we're thinking about, okay, what is the design of the policy? Okay, we got the base versus paid up additions, but you're not considering what are the fees of those paid up additions. Not every company is created equally, and unfortunately, people are not considering that when they're buying their policy. And so not the biggest factor in the world from a long-term perspective, but in a way it is, because if you put your money in every single year and paid up additions are going to be a big part of your annual premium, and you got a 1090 policy, and every dollar you're putting in, if you got a 10% fee, hypothetically, coming out of that paid up additions fee off the top, that can be just detrimental to the ability for that money to grow as quickly as you want. And that also impacts the liquidity of that money. There's no way around it. And so that's just something to take into consideration. And then ultimately when we take it beyond just the paid up additions load fee, the next thing to consider is the paid up additions flexibility. And this is the one that I think gets overlooked the most, because with all the people that we talk to and that I hear from the coaches on the team that are talking to clients, is the biggest consideration is how much flexibility do I have in my paid up additions rider? if I miss a payment this year, how can I make up for it? If I miss 3 years in a row where maybe I start the policy and I'm able to pay the paid up additions rider for 3 years, but then I have to like scale it down because I can't afford to make that premium because maybe I lost my job, maybe my business went through some hard times, maybe the economy went into a down cycle. What happens to my ability to make up for what was missed and to get back to normalized funding? Every company is going to handle that differently. So knowing your behavior, knowing how you plan on utilizing it, knowing where your risks are, it's really, really important to make sure that you pick the right company that gives you the ability to back fund as much as possible of the PUAs that you missed, and then also keep the PUAs going. Because I can think of one Big Four company in particular, I think a couple, but one that I'm thinking about, I'm not gonna name names, where if you miss the paid up additions for a couple years, you are going to go down the amount. Like let's say you did a 1090 policy on $100,000 and 90,000 of that was PUAs, and then for a couple of years you only funded the PUAs at $10,000, right? And so that was all you did for 2 years. Well, once you get past that time frame, you're only going to be able to go back and fund it at that level. You're not going to be able to bounce it back up to the full paid up additions amount. That's a problem, right? That's not the kind of flexibility and control that we're looking for. And when I preach control about these policies, one of the things that's really important to understand is control, and you being in control of your paid up additions flexibility is really important. There's a couple companies that excel in this if this is something that you need to do. This is where I would say, if that's something of concern to you, you're thinking about it, you're contemplating getting a policy, go ahead and set up a call with one of our coaches in the Clarity Call, and the link in the description below. They'd be happy to help you out, guide you through it, answer any questions that you have, kind of go from there. But those are the 4 things. We got to consider: what are the dividends? What are the paid up additions loads? What are the paid up additions flexibilities? And what are the loan rates? Those are 4 things that I think get really overlooked when it comes to designing whole life insurance policies. And not just designing them, but when you're making a decision as to what policy is best for you, those are the 4 things that, if you're looking at leveraging the money, those are the 4 things you need to consider. Because let's face it, you're not gonna just put your money in the policy and just let it sit and ride it out. If that's what you're doing with the policy, you're totally missing the point, you're totally missing the opportunity, and it's probably not the right policy for you. You're probably, if you're watching this channel, if you watch other influencers on YouTube talking about this, my guess is you're doing this, you're looking at this because you want to have a leverageable tool that's gonna help you accelerate the growth of your money. The only way you're gonna do that is by leveraging it. These are the 4 things that you need to consider if you're gonna leverage it, that are gonna have more of an impact on your growth than the policy design necessarily, and certainly the dividend rate. Like the dividend rate is the least important, so that's the thing to consider. So hopefully that helped. Hopefully that gave clarity. If you have any questions, go ahead in the comment section below. I'll be happy to engage with any single question that you have. If you haven't already, make sure you click the bell, subscribe and click the bell, that way you're notified every time I launch a new video. Hopefully you found value in this. If you did, share it out, like it, do all the things that YouTube loves to see. It helps the channel a lot. Grateful for you being here. Until next video, have a blessed, inspirational day. We'll talk soon. See ya.